So, if you see a government bleeding red ink, just running this massive, seemingly apocalyptic fiscal deficit, your first instinct is probably that the country is completely broke.
Right. Yeah. That's how everyone looks at it.
Because we are conditioned to look at a financial ledger and see a binary reality, like debt equals bad, surplus equals good. But today, we're looking at a stack of macroeconomic data that proves the exact opposite.
Which is so counterintuitive.
It really is. It shows that the governments with the ugliest balance sheets are often sitting right on top of the wealthiest private populations on Earth.
Yeah, it's an incredible dynamic to explore.
So for this deep dive, we're going to unpack the alchemy behind how nations turn massive debt into sovereign wealth funds, manipulate international capital, and, silently decide who wins and who loses in the global economy.
And it's crucial to grasp because the intuition you use for your household budget completely fails when applied to a nation state. I mean, the sheer scale of the mechanical realities of sovereign wealth, they operate on a fundamentally different plane of physics, and the timing for looking at these sources couldn't be better, honestly, considering the tectonic shift in global wealth management we're seeing right now.
Right, yeah. Our sources detail this massive pivot that happened back in February 2025.
A huge pivot.
The United States basically broke from its traditional free market, small government stance and initiated a Federal Sovereign Wealth Fund, or SWF.
Which, historically they were philosophically opposed to.
Exactly. And they are funding it through aggressive tariffs and federal asset sales, and then funneling that capital directly into domestic infrastructure and strategic technologies.
Yeah, the U.S. avoided this for the longest time, this idea of the federal government acting as an investment fund.
Mm-hmm.
But they are essentially just scaling up a model that certain U.S. states have operated for decades.
Like Alaska, right?
Exactly.
Yeah.
Alaska's permanent fund sits around $835 billion, mostly funded by energy revenues. And Texas manages massive permanent funds tied to land and minerals. So the federal government is finally building its own war chest.
But to understand why nations build these giant pools of wealth, we really have to understand the macroeconomic environment that necessitates them in the first place. Which brings us back to that massive red ink on the government ledger.
Right.
We are looking at countries running enormous trade surpluses, meaning they are exporting a massive amount of goods, while their government simultaneously runs staggering fiscal deficits.
And that is the core paradox of modern macroeconomics. You have to completely separate the concept of the country from the government.
Right.
A massive trade surplus means the country itself is pulling in incredible wealth. But that wealth is being captured almost entirely by the private sector, the manufacturers, the tech firms, the export companies, and the private citizens.
Okay, let's unpack this, because mathematically it sounds like a house of cards.
It does.
The classic sectoral balances equation comes to mind here, like private savings minus investment plus government taxes minus spending equals exports minus imports.
Exactly. That's the formula.
So, if the public sector is running a massive deficit, but capital is flying out via exports, the private sector must be hoarding a staggering amount of savings just to balance the math, right?
What's fascinating here is that the math absolutely demands it. If exports vastly outweigh imports and the government is spending way more than it taxes, the only mathematical reality is an insanely high private savings rate.
Wow.
Yeah, the citizens and corporations are literally saving enough to cover the government's shortfall and the massive capital flowing out. We see this heavily in the historical data for places like Japan, Germany, and China.
So it's like a family where the parents are completely broke and heavily in debt, but the kids are billionaires.
That is a great way to put it.
Like, the parents' bank account is overdrawn, but they can just infinitely borrow from their incredibly rich kids at a super low interest rate to keep the house running.
Precisely. The government isn't broke at all. It has access to massive, highly liquid domestic capital. Because the private sector is so wealthy, the government has this colossal potential tax base it can tap into if it really needs to.
Right. The money's right there.
And, more importantly, it can issue domestic bonds, and those rich citizens, or the institutions holding their savings, will eagerly buy them up. Add in the fact that the state has monetary sovereignty and controls the currency itself, and you have an incredibly stable financial engine, despite what those deficit numbers imply.
That makes total sense, and it explains the wealth accumulation in the private sector. But how does the government actually intercept those foreign dollars from the export companies?
The mechanics of it.
Yeah, because say an export firm making $100 million overseas gets paid in U.S. dollars, they still have to pay their local factory workers, their local suppliers, and their local taxes in their domestic currency.
Right. And the fiscal mechanics of that exchange are what drive the entire system. So that export company takes their 100 million US dollars to their local commercial bank to exchange for the local currency.
Okay.
The commercial bank processes the transaction, but now the bank is just holding a massive pile of US dollars. And their core business is domestic lending in the local currency.
So holding foreign cash is actually a liability for them.
Exactly. It's a liability for their operations.
Yeah.
So they push those dollars up the chain to the nation's central bank.
And the central bank just absorbs it all. Like they take the 100 million US dollars, lock it in their vault as a foreign exchange reserve, and literally expand their balance sheet.
Yep. They create the equivalent amount of new local currency digitally, effectively out of thin air, and credit the commercial bank's account.
Wow, so they literally print the money.
It is basically a hydraulic pressure system where foreign capital forces domestic money printers to run hot. But it's important to note, every new local note that enters circulation is mathematically backed by a hard U.S. dollar sitting in the central bank's reserve.
But wait, why resort to printing new money? I mean, the central bank has vast gold reserves, right?
Yeah.
And they hold their own government bonds.
Sure.
Why not use those finite existing assets to buy the incoming dollars instead of just inflating the money supply?
It's a question of scale. The sheer scale of a national trade surplus makes that impossible.
Yeah.
We're talking about hundreds of billions of dollars flowing into the country annually.
Oh, wow. Yeah, okay.
If a central bank tried to use its physical gold reserves to buy those incoming dollars, they would drain their entire national gold vault in a matter of months.
Just gone.
Exactly. Plus, a booming export economy fundamentally requires an expanded money supply. As the country's GDP physically grows, more factories, more workers, more transactions, the economy simply needs more liquid currency circulating to function.
Right, because if the money supply stayed static while the economy doubled in size, you would trigger, vicious crushing deflation. So printing backed currency is necessary to lubricate the growing economy. But flooding the domestic market with all that newly printed local cash introduces a brutal side effect for the people actually living there.
It does. The currency gets caught in a tug-of-war between two opposing forces. Internationally, the currency is appreciating. Foreign buyers constantly need it to purchase the country's manufactured goods, driving its value up on the global exchange.
But domestically.
But domestically, because the central bank just injected a tidal wave of new local money into the system to buy up those dollars, the domestic purchasing power drops. You get inflation.
And economists refer to a large part of this as the Balassa-Samuelson effect.
Right, it's a classic model.
Which is so interesting. It basically says the booming, highly productive export companies are making massive profits. So they raise wages to attract top-tier engineers and managers. But because those export wages rise, local non-tradable service industries like hospitals, neighborhood restaurants, barbershops, they are forced to raise their wages too, just to stop their employees from leaving for the export factories.
Exactly. The barbershop didn't suddenly become 50% more productive,
No.
but they still have to pay their barbers 50% more just to retain them.
Right.
So to survive, they drastically raise the price of a haircut. The ultimate result is a robust international exchange rate, paired with uncomfortably high, sticky domestic prices for the everyday citizen.
Here's where it gets really interesting, because the sources detail the Cantillon effect, which highlights that this inflation isn't distributed equally at all.
Oh, not at all.
If you think of the economy as a massive buffet line, the export companies are standing at the very front. The central bank prints the new money and funnels it directly to them first, through the commercial banks.
Yeah.
They get to take that new highly valued money and buy up all the premium resources, like land, labor, raw materials, at the original low prices.
Yes, and because they get to the front of the buffet first, they don't just eat the premium food, they basically buy up the tables and the chairs too.
Exactly.
By the time that newly printed money circulates down to the pensioner or the everyday worker at the very back of the line, the premium assets are long gone, and they are paying double just for the scraps left over.
It's wild. So if you are an average citizen holding your savings in a standard domestic bank account while your central bank is running this operation, you are the one silently paying for your country's global export dominance.
Yeah,
Your
unfortunately.
savings are being diluted. It's an invisible wealth transfer.
Inflation in this macroeconomic architecture operates as an invisible regressive tax. It silently siphons purchasing power away from the late receivers of the money and funnels it toward the state and the earliest receivers, which is the export sector.
That's brutal.
But keeping that inflation invisible is a high-wire act. If the central bank just left those newly printed billions freely circulating in the domestic system, they wouldn't just have inflation. They'd trigger a catastrophic economic collapse known as Dutch disease.
Because if the local currency becomes too strong internationally, every other domestic manufacturing sector instantly becomes too expensive for the rest of the world to buy.
Exactly.
The export giants survive, but the rest of the country's industries are hollowed out, so they need a massive pressure valve, which is where the sovereign wealth fund steps in.
Right. The government has to intercept the capital before it floods the village, so to speak. They do this through a crucial mechanism called sterilization.
Sterilization, okay.
The government's Treasury Department issues government bonds, essentially offering to borrow money from the domestic public at an attractive interest rate. And the public uses their newly printed local currency to buy those bonds.
Okay, so the Treasury soaks up the excess local currency from the domestic market. They then take that local currency, walk it over to the central bank, and use it to buy those U.S. dollars sitting in the vault. So now the Treasury controls the U.S. dollars.
And they immediately inject those dollars into the sovereign wealth fund. And the SWF sends that capital right back out of the country.
Wow.
They use the dollars to acquire foreign assets like buying up tech startups in Silicon Valley, prime commercial real estate in London, or critical infrastructure projects in developing nations.
Wait. This raises an important point of skepticism for you, the listener. The government is essentially going into massive domestic debt, issuing bonds and owing its own citizens money, just so it can play global monopoly with real estate abroad.
Right. On paper, it sounds completely absurd.
Yeah, like why do that?
This raises an important question. Why take on the domestic liability at all? Well, because it is a brilliantly engineered asset swap. By executing this maneuver, the government intercepts the dollars at the border.
Oh, I see.
They remove the inflationary excess local currency from the domestic market, crushing the inflation threat. Instead of letting those dollars sit idle in a vault or wreck the local manufacturing base through Dutch disease, they turn potential economic ruin into hard, strategic global power.
So they defend the domestic economy while projecting financial imperialism globally. It's a masterful system.
It really is.
But this entire architecture relies on the underlying reality that everyone, everywhere, demands U.S. dollars. So the U.S. is basically at the apex of this global currency pyramid.
Absolutely.
But I'd imagine the Eurozone and Japan sit right below them. They don't have the ultimate hegemony of the dollar, but they have bond markets deep enough to absorb massive shocks without immediately breaking.
Yeah, the hierarchy is rigid. At the very top, the U.S. Federal Reserve doesn't need foreign currency to back its printing. It backs its currency with U.S. government debt, which is underwritten by global military hegemony and the future tax power of the American economy.
Right.
Because global commodities like oil are priced in dollars, the U.S. effectively exports its inflation to the rest of the world. And then in the middle tier, as you mentioned, are the euro and the Japanese yen.
Japan is a fascinating case study in how the middle tier survives, specifically with how aggressive their central bank has been with yield curve control.
Oh, yield curve control, or YCC, is a perfect example of mid-tier macroeconomic defense. For years, the Bank of Japan artificially capped the yield on their 10-year government bonds at roughly 0%.
Wow.
If the free market tried to push interest rates higher, the central bank stepped in as the buyer of last resort. They purchased an unlimited amount of government bonds with newly printed yen just to force the yield back down.
So they basically monetized their own debt. At one point, I think the Bank of Japan owned more than 50% of all outstanding Japanese government bonds.
It was an extreme closed loop, a self-funding mechanism. The government issues debt, and the central bank prints money to buy it, keeping borrowing costs near zero.
But how does that not just blow up?
Well, a system that highly leveraged only survives because the global market fundamentally trusts the sheer productive power, the massive foreign assets, and the social stability of the Japanese economy. The yen might fluctuate, but the market knows Japan won't default.
So what does this all mean for the bottom tier of the pyramid? Because not everyone has the productive capacity of Japan or the military backing of the U.S.
If we connect this to the bigger picture, the bottom tier, so emerging markets across parts of Africa, South America, and Southeast Asia, they live in a state of constant macroeconomic vulnerability.
Yeah.
They suffer from a condition economists call original sin. It refers to their fundamental inability to borrow long-term funds on the international market in their own local currency.
Because global investors have zero trust in the long-term purchasing power of that emerging currency.
Exactly.
If the country wants to build a deep-water port or a high-speed rail line, they're literally forced to borrow in U.S. dollars or euros.
And that debt creates severe fragility. Because if a global economic shock hits and investors panic, capital flees the emerging market. The central bank there doesn't have a massive sovereign wealth fund or deep dollar reserves to defend their currency.
Oh, man. So the local currency's value just plummets.
It plummets. Suddenly, the local cost of servicing that dollar-denominated national debt doubles or triples overnight, leading to sovereign defaults.
If you are an expat taking a job in one of these bottom-tier countries, the volatility is a direct threat to your personal wealth.
The risk is absolute. When these weak currencies start to crash, governments often institute draconian capital controls. They make it physically illegal to convert your local money back into dollars or transfer it across borders.
Just trapping the capital inside the country to artificially prop up the banking system.
Right. If you are earning in a currency suffering from original sin, the golden rule is to convert your earnings to a hard anchor currency immediately.
Wow, we have covered massive ground today.
We really have.
We completely inverted the idea of a government ledger, showing how a fiscal deficit combined with a trade surplus actually signifies massive private wealth hoarding.
Yep.
We explored the hydraulic pressure of central banks printing currency to buy export dollars, and how the Cantillon effect operates as an invisible tax, diluting the savings of the everyday citizen while rewarding the massive exporters.
Which ultimately forces the creation of sovereign wealth funds. They serve as critical interceptor dams, executing sterilization maneuvers to neutralize domestic inflation, prevent Dutch disease, and project state capital abroad.
And all of these complex mechanics operate strictly within a defined global hierarchy, anchored entirely by trust in the U.S. dollar at the peak.
The absolute bedrock.
But here is a final provocative thought to leave you with, something to mull over that builds on this entire architectural reality. This system works because the bottom of the pyramid is forced to trust the top.
Right. The dollar is the inescapable bedrock of international trade.
But the global economy is slowly detaching from physical borders. We are seeing the relentless development of decentralized finance, cryptographic networks that settle billions of dollars in value without a central bank intermediary.
Which is a massive shift.
Simultaneously, we are moving from a physical manufacturing-heavy world into an AI-driven, purely digital economy where the most valuable assets are algorithms and compute power, not physical commodities shipped across oceans.
Right.
So what happens if the bedrock anchor of the U.S. dollar begins to rust? If the emerging markets at the bottom of the pyramid find a decentralized, borderless alternative for trade settlement, will the central bank's hydraulic pressure system fail?
That's the billion-dollar question.
If trust evaporates, we might see the entire global currency hierarchy flip entirely on its head.
It is the defining macroeconomic question of the next decade.
Next time you look at a bank statement or a national deficit report, remember, the redding and the blacking are just the surface. The real truth, the real power, is hidden in the mechanics of how that money is intercepted, sterilized, and deployed. Thank you for joining us on this deep dive into the hidden mechanics of global wealth. We'll catch you next time.